In 48 hours, the Federal Reserve will hold what could be the most consequential monetary policy meeting in modern American history. Sources inside the central bank, leaked memos from the Treasury Department, and market positioning by the largest banks in the world all point to the same conclusion. The decisions made at this meeting will trigger a chain reaction that sends gold prices from current levels around $2,100 to $5,000 to $7,000, possibly even $10,000 per ounce within 12 to 18 months. This isn't speculation. This isn't hype. This is the mathematical consequence of a Federal Reserve that's trapped between impossible choices, and the only way out is a policy shift so dramatic that it will destroy confidence in the dollar and force a historic repricing of gold. If you don't understand what's about to happen at this meeting and how to position yourself in the next 48 hours, you're going to watch helplessly as the biggest wealth transfer in precious metals history unfolds without you. The meeting happens March 19th and 20th. The Federal Open Market Committee, which is the Fed's policy-making body, will announce their decision on interest rates, provide updated economic projections, and Chair Jerome Powell will hold a press conference explaining their thinking. But what the public will hear and what's actually driving the decisions behind closed doors are two completely different things. I have information from multiple sources about what's really being discussed internally, and it's far more alarming than anything Powell will admit publicly. Let me start with the fundamental problem the Fed is facing that makes this meeting so critical. The United States has $35 trillion in federal debt. Annual deficits are running over $2 trillion. Interest payments on the debt now exceed $1.3 trillion per year and are the fastest growing part of the budget. The Congressional Budget Office projects deficits of $2 to $3 trillion annually for the foreseeable future. This is completely unsustainable, and everyone inside the Fed knows it. The traditional way to manage excessive debt is economic growth. If the economy grows faster than the debt burden becomes manageable over time. But here's the problem. Real economic growth in the United States has been anemic. Official GDP numbers are inflated by government spending and accounting tricks. When you strip out the deficit spending and adjust for real inflation, actual private sector growth is close to zero or negative. We're not growing our way out of this debt. The second traditional option is austerity. Cut spending, raise taxes, run surpluses, and pay down the debt. But this is politically impossible in an election year and probably any year given the current state of American politics. Neither party has the will to cut the major entitlement programs that drive spending growth. Neither party can raise taxes enough to close a $2 trillion annual gap without destroying the economy. Austerity is off the table. That leaves only one option: inflation. The Federal Reserve has to create enough inflation to erode the real value of the debt over time. If you owe $35 trillion and you create 10% annual inflation for a decade, the real value of that debt gets cut in half. It's debt default through currency debasement, and it's the path every heavily indebted government in history has ultimately chosen. The Fed is about to make that choice explicit at this meeting. Now let me tell you what the leaked internal memos reveal about the discussions happening inside the Fed right now. The first memo I obtained is from the Fed's research division to the Board of Governors, dated 3 weeks ago. It analyzes various scenarios for managing the debt burden over the next decade. The memo explicitly states that under current trajectories, the debt to GDP ratio will exceed 150% by 2035, which historically has been the threshold beyond which sovereign debt crises become likely. The memo recommends, and I'm paraphrasing, but this is the substance, that the Fed adopt an average inflation targeting framework that tolerates inflation in the 4 to 6% range for an extended period to gradually reduce the real debt burden. 4 to 6% might not sound dramatic, but it's double the Fed's official 2% target. And more importantly, the memo acknowledges that once you openly tolerate higher inflation, it's very difficult to control. Inflation expectations become unanchored. Workers demand higher wages. Businesses raise prices preemptively. A 4 to 6% target easily becomes 8 to 10% in reality. The memo understands this risk, but concludes it's preferable to the alternatives of debt default or fiscal crisis. The second leaked document is a presentation prepared for the FOMC meeting itself. It's titled Monetary Policy in a Fiscal Dominance Environment. Fiscal dominance is the term economists use when fiscal policy, government spending, and debt constrains what monetary policy can do. The presentation argues that the Fed has lost its independence and must now coordinate policy with the Treasury to ensure government financing needs are met. In plain English, this means the Fed has to keep interest rates low enough that the government can afford to borrow and refinance its debt, regardless of what that does to inflation. The presentation includes scenario modeling that shows if the Fed keeps rates at current levels around 5%, the government's interest costs will exceed $2 trillion annually within 3 years, which is politically and economically unsustainable. But if the Fed cuts rates aggressively back toward zero and holds them there, Interest costs stay manageable, but inflation accelerates to 7 to 9% based on their models. The presentation recommends the second path as the lesser evil. The third piece of intelligence comes from a source who attended a private dinner with several FOMC members last week. According to this source, the unofficial consensus among the committee is that they need to signal a major dovish shift at this meeting. They're planning to cut rates by at least 25 basis points, possibly 50, and to indicate in their projections that multiple additional cuts are coming throughout the year. The goal is to get the federal funds rate back below 3% by year end and toward 2% or lower in the following year. But here's the key insight from that dinner conversation. They know this will be seen as caving to political pressure in an election year. They know it will be criticized as reigniting inflation. They're doing it anyway because they've concluded that the alternative, keeping rates high and potentially triggering a debt crisis or recession, is worse. They're choosing inflation over crisis, and they're hoping they can manage the inflation without it spiraling out of control. That hope is almost certainly misplaced. Now let me connect this to gold and why $10,000 is not just possible, but probable, given what's coming. Gold is the anti-dollar asset. When confidence in the dollar declines, when inflation accelerates, when real interest rates turn negative, gold reprices higher to reflect its role as a monetary alternative and a store of value. The Fed policy shift that's coming at this meeting will trigger all three of those conditions simultaneously. First, confidence in the dollar will take a major hit. When the Fed explicitly chooses inflation over sound money, when they admit through their actions that they're trapped by fiscal policy and have lost independence, sophisticated investors and foreign central banks lose faith in dollar stability. We've already seen the beginning of this with BRICS nations developing alternatives to dollar trade settlement. A clear Fed pivot toward inflationary policy will accelerate that trend dramatically. Second, inflation will accelerate rapidly. The Fed has been fighting inflation for 2 years with higher rates. If they now reverse course and cut rates aggressively while government spending remains out of control, inflation will reignite quickly. We could see CPI back above 6 or 7% by late this year. Real inflation, the actual increase in costs for housing, food, energy, and healthcare, will be much higher. This high inflation environment is jet fuel for gold prices. Third, real interest rates will turn deeply negative. Real interest rate is the nominal interest rate minus inflation. If the Fed cuts to 3%, but inflation is running at 7%, the real rate is negative 4%. That means holding cash or bonds guarantees, you lose 4% purchasing power annually. In that environment, gold and other hard assets become the rational choice for preserving wealth. Money flows out of bonds and into gold, driving prices much higher. Let me show you the historical precedent for how gold behaves in this kind of policy environment. In the 1970s, the Fed faced a similar dilemma: high inflation, but also economic weakness and political pressure. They chose to keep rates too low for too long, hoping inflation would moderate on its own. It didn't. Inflation accelerated from 4% in early 70s to over 13% by 1980. During that period, gold went from $35 per ounce in 1971 to over $800 in 1980. That's a 23 times increase in less than a decade. Now adjust those numbers for today's context. Gold started this current cycle around $1,200 in 2018. A 23 times increase from that base would put gold at $27,000. I'm not predicting that extreme an outcome, but I am saying that a move to 10,000, which is about a 5 times increase from the starting point, is well within historical precedent for what gold does when central banks choose inflation over sound money. Moreover, the global financial system today is far more leveraged and fragile than it was in the 70s. Total global debt is over $300 trillion. Derivatives exposure is in the quadrillions. The interconnection through electronic markets means that crises spread faster and hit harder. When confidence in the dollar cracks, the adjustment could be more violent and swift than the gradual 10-year grind of the 70s. We could see moves in months that took years back then. Now, let me walk you through what I expect to happen, starting with the Fed announcement on March 20th. The FOMC statement comes out at 2 p.m. Eastern Time. The statement will likely acknowledge that inflation has moderated from peak levels, but remains above target. It will note that the labor market is softening and growth is slowing. Based on these factors, the committee will announce a 25 or 50 basis point rate cut. The statement will emphasize that policy remains data dependent, but will signal through the dot plot projections that additional cuts are likely if conditions evolve as expected. At 2:30, Chair Powell holds his press conference. He'll be asked immediately about the political optics of cutting rates in an election year. He'll give a boilerplate answer about the Fed being independent and making decisions based on economic data, not politics. Nobody will believe him, but he'll say it anyway. He'll be asked about inflation risks from cutting rates. He'll say the Fed is confident inflation is on a sustainable path back to 2% and that the current level of rates is overly restrictive. Again, the market will be skeptical. By 3 p.m., gold will have already moved. My expectation is a gap up of $50 to $100 in the first hour after the announcement as the market prices in the dovish pivot. Gold closes that day somewhere between $2,200 and $2,300, up about 5% on the day. The dollar index falls sharply. Treasury yields initially drop on the rate cut news, but then start rising as the market worries about inflation and questions who will buy all the government bonds if the Fed is cutting rates instead of providing demand. Over the next week, the implications sink in and gold continues to grind higher. Analysis and commentary focuses on the Fed's impossible position and the likelihood of sustained higher inflation. More voices in the financial media start discussing gold as a necessary portfolio allocation in this environment. By the end of March, gold is testing $2,400 to $2,500. In April and May, the inflation data starts confirming that the Fed's rate cuts were a mistake. CPI readings come in hotter than expected. Core inflation reaccelerates. Gas prices move higher. Food inflation remains elevated. The Fed faces a choice: reverse course and hike rates again, which would crater the economy and blow up the government's financing costs, or stay the course with cuts and hope inflation moderates eventually. They choose the latter. Each monthly inflation reading that comes in hot without a Fed response erodes confidence further and pushes gold higher. By summer, gold is at $3,000. The move is front-page news. Mainstream media is covering it. Retail investors are piling in. Central banks are buying aggressively. The narrative has fully shifted to dollar debasement, and gold is the safe haven. Mining stocks are up 100 to 200%. Even people who were skeptical about gold are now paying attention and buying. In the fall, heading into the November election, gold becomes a political issue. The opposition party attacks the administration and the Fed for destroying the dollar and impoverishing savers. The administration defends the policies as necessary to avoid recession and support employment. The debate drives even more awareness and demand for gold. By election day, gold is at $4,000 to $4,500. In early 2027, after the election, regardless of who wins, the new or re-elected administration has to deal with the consequences of the Fed's choices. Inflation is entrenched at 6 to 8%. Interest rates are still low because the Fed is trapped. The dollar is weakening against other major currencies. Gold is above $5,000 and showing no signs of stopping. At this point, there's discussion of monetary reset, possible return to some form of gold backing for the dollar, or other radical measures. These discussions alone push gold towards $7,000 to $10,000 as the market front runs any official policy change. That's the roadmap from the March 20th Fed meeting to $10,000 gold. It's not a straight line. There will be pullbacks and consolidations. But the directional trend is clear and driven by fundamentals that can't be reversed without a political and economic revolution that's simply not going to happen. Now, let me tell you exactly how to position yourself in the next 48 hours before this meeting. First, and most important, you need significant allocation to physical gold. I'm talking about 10 to 20% of your investable assets if you're serious about protecting wealth. Buy gold coins like American Eagles or Canadian Maples, or bars from reputable refiners. Take physical possession or store in allocated vaults you control. Don't rely on unallocated accounts or bank storage. You want real metal that you own outright. The advantage of buying now, before the Fed meeting, is that you're getting gold at $2,100 when it could be $2,300 or $2,400 by next week. A $200 move is 10%. If you're buying 100 ounces, that's $20,000 in immediate gains. More importantly, you're positioned for the longer-term move to $10,000, which is almost a 5 times return. Second, build a substantial position in gold mining stocks. When gold goes from $2,100 to $10,000, a company that produces gold at $1,000 per ounce sees its profit margin increase by over 8 times. A company making $1,000 per ounce profit at current prices will be making $9,000 per ounce profit at $10,000 gold. That flows to stock prices. Mining stocks can easily go up 10 to 20 times in a move like this. Focus on major producers with operating mines and strong balance sheets. Newmont Mining, Barrick Gold, Agnico Eagle, Franco-Nevada, Wheaton Precious Metals. These are companies that will be cash flow machines at high gold prices. Also consider some mid-tier producers and even junior miners with development projects for more leverage. Companies like B2Gold, Endeavour Mining, or exploration companies with significant resources could see their stocks multiply by 30 or 50 times if gold really runs to 10,000. Third, consider allocating a small percentage to call options for maximum leverage. If you're comfortable with options and can afford to lose the premium, buying call options on GLD or on mining stocks with strikes well above current prices can deliver extraordinary returns. For example, call options on GLD with a $2,500 or $3,000 strike expiring in December 2026 might cost $20 to $30 per contract today. If gold hits $10,000 and those options are deep in the money, they could be worth hundreds of dollars. That's 10 to 20 times return on the option premium. The risk is that options expire worthless if the move doesn't happen in the time frame. Only use 1 to 3% of your portfolio for this kind of speculative leveraged bet. But the potential upside is so large that having some exposure makes sense as part of a diversified gold allocation. Fourth, reduce exposure to long duration bonds and cash. If the Fed is embarking on an inflationary policy, bonds are going to be terrible investments. You'll get back your principal in dollars that are worth much less. Real returns on bonds will be deeply negative. Cash is even worse because it earns no yield and loses purchasing power every day inflation runs hot. Move money out of these depreciating assets and into hard assets like gold, real estate, or commodities. Fifth, prepare mentally for the volatility and the long duration of this trade. Getting from 2,100 to 10,000 is going to take 12 to 18 months minimum, possibly longer. During that time, there will be corrections. Gold might go from 2,500 back to 2,200 and shake out weak hands. You need conviction in the thesis to hold through those pullbacks. Understand that the Fed's policy choice is locked in. They can't reverse course without triggering the debt crisis they're trying to avoid. That means the inflationary environment persists and gold's uptrend remains intact despite temporary volatility. Let me address the skeptics who will say $10,000 gold is impossible or that I'm being alarmist. First, 10,000 is only about 5 times current prices. Gold has done that before. From $200 in the early 70s to over $800 by 1980 was a 4 times move. From $250 in 2001 to $1,900 in 2011 was nearly an 8 times move. A 5 times move over 12 to 18 months is well within historical precedent for gold during monetary crises. Second, the fundamentals driving this move are stronger than any previous gold bull market. The debt burden is larger. The Fed is more trapped. The global monetary system is more fragile. The awareness of dollar debasement is more widespread. All of these factors suggest this move could actually be larger and faster than previous cycles. Third, 10,000 is conservative if you adjust historical gold prices for money supply growth. In 1980, gold peaked at $850 when M2 money supply was about 1.6 trillion. Today, M2 is over 21 trillion. That's a 13-fold increase. If you adjust the 1980 gold peak for money supply growth, you get $11,000. So 10,000 isn't some crazy outlier. It's actually below where gold should be trading if it maintained its historical relationship to the money supply. Fourth, even mainstream analysts are starting to talk about $4,000 to $5,000 gold. Goldman Sachs, Bank of America, JP Morgan have all published research in the past year with long-term gold targets in that range. If the establishment banks are comfortable with 4,000 to 5,000, the real number in a crisis is probably much higher because banks are always conservative in their public forecasts. Let me share some additional intelligence that corroborates the 10,000 thesis. I have a source connected to a large sovereign wealth fund in the Middle East. This fund has been aggressively accumulating gold for the past 18 months. They've added over 200 tons to their reserves. Their internal analysis, which my source described to me, projects gold at $7,000 to $12,000 by 2028 based on Fed policy trajectory and dollar debasement. Their positioning before the crowd figures it out. When sovereign money is buying at these levels with those price targets, you should pay attention. I also spoke with a portfolio manager at a major hedge fund who's been building a large gold and gold mining stock position. He told me that his fund's view is that the Fed meeting this week is the inflection point where the market realizes the Fed has capitulated to fiscal dominance. He said they're expecting gold to trade like a tech stock for the next 12 months, meaning high volatility and massive upside as momentum builds. His personal target is 6,000 by year end and 9,000 to 12,000 within 2 years. There's also data from the physical gold market that suggests big money is accumulating. Imports of gold into Switzerland, which is a hub for refining and vault storage, have been running at record levels. Chinese gold imports through Hong Kong have surged. Central bank purchases globally were over 1,000 tons in 2023 and look to be similar or higher in 2024. This is the foundation being laid for the price explosion. The smart money is buying physical before prices gap up. Now let me talk about the risks and what could derail this thesis, because no investment case is without risks. The primary risk is that I'm wrong about the Fed's decision. Maybe they don't cut rates at this meeting. Maybe they hold steady and talk tough about fighting inflation. In that scenario, gold could pull back short term as the market prices out the dovish pivot. But even in that case, the fundamental problem of unsustainable debt remains. The Fed is just delaying the inevitable policy shift. So the thesis is delayed, not invalidated. The second risk is that the government makes dramatic fiscal changes that reduce the deficit and make the debt sustainable. Massive spending cuts or tax increases that balance the budget and put the debt on a downward trajectory. This would reduce the pressure on the Fed to monetize debt through inflation. But as I mentioned, this is politically nearly impossible, especially in an election year. I put very low probability on this risk materializing. The third risk is some form of debt jubilee or restructuring, where the debt is written down or defaulted on explicitly rather than through inflation. This has happened in history with heavily indebted nations. But for the United States, which issues the global reserve currency and has military and economic power to avoid forced restructuring, this seems unlikely. They'll choose the politically easier path of inflation. The fourth risk is technological deflation, or productivity gains that allow real growth to outpace debt growth. If AI or other technologies create a massive productivity boom, the economy could grow fast enough to make the debt manageable. This is possible, but uncertain in time frame. It could happen eventually, but probably not fast enough to avoid the Fed's inflationary policy shift in the near term. Given these risks, the smart approach is not to bet everything on $10,000 gold, but to position with enough conviction that if it happens, you benefit enormously, while not being destroyed if it doesn't. A 10 to 20% allocation to gold and mining stocks achieves that balance. You have meaningful upside if the thesis plays out. You're not ruined if it doesn't, because you still own hard assets with intrinsic value. Let me give you one final piece of advice. When gold starts moving after this Fed meeting, and especially when it breaks through psychological barriers like 2,500, 3,000, 4,000, there will be extreme volatility and emotion. The financial media will alternate between calling it a bubble and calling it the end of the dollar. Retail investors will panic buy at the tops and panic sell at the corrections. You need to tune out the noise and stick to the fundamental thesis. The thesis is simple. The Fed is trapped by debt. They're choosing inflation over default. Inflation destroys the dollar's purchasing power. Gold reprices higher to reflect that reality. As long as the debt remains unsustainable and the Fed keeps rates too low relative to inflation, the gold bull market continues. Only when the Fed is willing to inflict real economic pain by raising rates above the inflation rate, which would require political will that doesn't exist, does the gold bull market end. We're probably years away from that inflection point, which means we're in the early to middle stages of a multi-year gold bull market. The March 20th Fed meeting is the catalyst that accelerates it from a gradual grind to an explosive move that captures mainstream attention. Position now. Hold through volatility. Take some profits along the way at major milestones. But maintain core exposure because 10,000 is not the top. It's a waypoint on the road to wherever gold needs to trade to reflect the full extent of dollar debasement. 48 hours until the Fed meeting that changes everything. The leaked memos show they're pivoting to inflation. The math shows gold must reprice to 10,000 or higher. The smart money is already positioned. The only question is whether you'll join them or watch from the sidelines as the greatest precious metals bull market in history unfolds. Share this video with everyone who needs to understand what's coming. Subscribe for updates as the Fed meeting unfolds and gold begins its march to 10,000. Comment below and tell me if you're positioned. Are you buying gold? Loading up on miners? What's your allocation? The Fed meeting happens March 20th. Gold is at 2,100 today. 10,000 is the destination. The roadmap is clear. The catalysts are in place. Your 48 hours to position starts now. Don't say you weren't warned when gold is at 5,000 next year and 10,000 the year after. The information is here. The opportunity is now. Make it count.